Topic 12 starts today, and it deals more with sales and purchases. We've had both quite a bit so far, and now we're going to add a bit more to all of that. And we will be using the ABC Bookstore. You see this on your screen. You see a chart of accounts. We've looked at a chart of accounts before, and we will be using the ABC Bookstore quite a bit in the next week or so. Again, I want to remind you what the LLC stands for behind the name of the business. LLC stands for Limited Liability Company, and it deals with something very similar to a corporation. We have Microsoft, we have Apple, General Motors. Those very large companies are always incorporated. You see the INC behind their name. Microsoft Incorporated, for example. Basically, that means that the stockholders, the owners of the business, are not liable personally for any debts of the business. So that if the business declares bankruptcy or is sued, the owners or the stockholders don't have to worry about creditors coming after their house or their car, that sort of thing. A similar situation exists for small companies like the ABC Bookstore. This may be family owned, owned by a few people, but they want to protect their personal assets as well in case of bankruptcy or being sued, for example. So the LLC helps protect them. And we'll talk more about corporations, large and small, a little later in the course, but I wanted to remind you what the LLC stands for. The chart of accounts, again, has two basic parts, the general ledger and the subsidiary ledger. In the general ledger, on the chart of accounts, balance sheet accounts are listed on the left, income statement accounts listed on the right. At the bottom, you would see the subsidiary ledgers listing accounts receivable, listing all the customers we have in our business, and listing on the right the accounts payable ledger listing all the creditors that we have. You may have seen these customers and creditors before, and we'll use them again. So what we want to look at, particularly in topic 12, will be the operating revenue and the costs of merchandise sections. These are both income statement accounts. First of all, with the operating revenue, you see three accounts now. Sales we've had since day one with the customers buying something from us. Sales discount we've had recently. This is a situation where we give a reduced amount, a percentage off if the customer pays us early. So we may take off 2% if the customer pays us within 10 days. We've had a number of problems with that. Now we will look at something called sales, returns, and allowances. This deals with, first of all, a return. Customers sometimes, for whatever reason, return merchandise to us, and to keep customers happy, as long as they have a receipt, we'll take it back. Usually stores will do that without any hassle, without any questions as to why you're returning it. So that's a return. And we will give them credit or we will give them their money back. An allowance is a situation a little less common, but it could happen where a customer gets something home and realizes it's the wrong color, the wrong model number, whatever, but is willing to keep it. So they contact the store and say, listen, you sent me the wrong thing. And the store says, well, if you are happy to keep it, we will allow you some money off. So instead of paying us $25, pay us $20, for example. That would be an allowance. Purchases and purchases discounts, we've had a lot. Again, the opposite situation. Purchases means we are we're buying some merchandise, and a discount would be when we pay early, we may be able to take some money off. We've talked about that before. Purchases, returns, and allowances, again, deals with a situation where we either return something and we get our money back, or we get credit, or we get an allowance which gives us the ability to pay a little less than the actual cost. So we'll talk about how that works with purchases and with sales. Before we leave this chart of accounts, I want to go back to something you've had before also. On the balance sheet side, this company has a delivery truck and accumulated depreciation. We've had that quite a while ago now. But the point I want to make is that this accumulated depreciation account we call a contra account. When we bought the delivery truck for $60,000, for example, that amount stays in the account on the debit side. The accumulated depreciation will show how much value the truck has lost over the years. So that's a contra account. The same thing happens with sales and purchases. Sales is typically credited when we sell something, and the sales returns and allowances would be an account with a debit balance, and that would be a contra account, as we'll see. Purchases, typically a debit balance when we purchase merchandise, but the purchases, returns, and allowances would be a contra account with a credit balance, as we will see. So let's take a look at a couple examples. Down at the bottom, we have our journals, our 4 journals that we've had before are at the bottom here. So first one is sales, and there is one entry in here, and we'll come back to this, but let's walk through it real quickly here. April 1st, St. Michael's High School is a customer, and they bought something on account from us. Accounts receivable is debited. Their account would be debited by the same amount. Sales is credited. The sale actually is $250, and we had to add $14.38. Sales tax 5.75% is used, and the customer will pay us not only the $250, but he or she also has to pay, in this case, $14.38. So the total amount owed to us is $264.38. Eventually, that goes to accounts receivable debit on the debit side, and also to the debit side of St. Michael's High School. At the end of the day, the totals, if there's only one entry here, there's one total, and that would be posted to the general ledger accounts. In this case, accounts receivable account, in this case sales, in this case sales tax payable. And those would be posted, and the numbers at the bottom indicate that the posting has already been done. So we'll come back to this, though, in our example a little later. We also have a purchases journal. We also have a cash receipts journal, and this does have one entry, and this is cash sales. And again, the sale in this case was $42. We had to add the sales tax, and the total amount that we received, because this was a cash sale, is $44.42. So we don't need an account or a customer's name here, so we use the slash. And because there's no individual posting, a slash here in posting reference. If this is the only sale of the day, then we post to not only, actually we post to 3 accounts. The sales account would be credited by 42, sales tax payable would be posted, and the cash would be posted. And you'll see the numbers below indicating that the posting has been done. Cash payments we're not using quite yet. And then this will show general ledger account accounts. There are quite a few of them here as we scroll through. We're not going to use all of these accounts right now in this example, but we'll use a couple of them, as we'll see. Accounts receivable, this lists the customers, and by looking at it, you can tell that only 2 of them, J.K. Rowling, owes us $190.35, and here's the $264.38 posted to St. Michael's High School account. They owe us that much money. And finally, we have a listing of the 6 creditors that we owe money to, and we only owe money to a couple of them, as you can see. Now, let's go back to cash receipts for a moment, and let's take a look at a situation where a customer returns something for cash. To make it very simple, let's say we're talking about this entry on April 1st, and let's say this sale was only made to one customer. We didn't need his name or her name because it was a cash sale. But let's say the customer came back later the same day and said, I want to return this for whatever reason, and we're happy to keep the customer happy, so we will give the money back. So if we're paying money back to the customer, we need to handle that in the books of the business. So we do that since we're paying money to a customer. We will use the cash payments journal. And let me illustrate how this entry would look. Let's say it's later the same day. So April 1st, the customer comes back and returns the merchandise to us. There are 3 accounts used. First one will be this one, the new one that we looked at earlier. Sales, returns, and allowances. I didn't spell that correctly. And let's assume, to make it very simple, that we use the source document as a check. Let's just say it's $219. Typically, we might give this customer either credit to go buy something else, or we may actually give that customer cash back. To keep it simple here, let's just say we write a check. Cash makes it a little more complicated, as we'll see later, but to keep it simple, let's say we wrote a check to pay this customer back. So the debit here has to go to sales, returns, and allowances. And the amount used is, whoops, that is the wrong amount. It's $42. The original entry had a credit to sales of $42. So we want to nullify that by using the contra account. So we debit the $42 to sales, returns, and allowances. Now, tax was involved as well. So we have to use sales tax payable. There's not a special column for sales tax payable here, so we have to use the debit column. So again, we want to show that this sales tax is no longer something that we're going to collect. So that amount was $242. If we looked at back in the original entry, we credited sales tax payable. We credited it by $2.42. Now we need to nullify that and make it balance out to 0. So that's why we debit $2.42. And then cash gets credited by the full amount. So that we now have reduced the amount of cash because we paid the customer back the total amount that he or she paid us to begin with. If we look back in the original entry, we received $44.42. Now we are returning $44.42, so we credit cash. So that's how this entry is done. Excuse me. So we have some kind of an explanation at the bottom of it. Cash return or return of merchandise for cash, something like that at the bottom, just to indicate what this account is or what this transaction is all about. So this is how this is done when a cash customer returns something to us. They originally purchased it for cash, so now when they return it to us, we have to refund the total amount customer paid to us, and sales taxes involved. So again, this is how we will handle a situation when we refund cash. The next video that you'll see in a moment here, there are 2 videos to this particular example, only because this runs out after 15 minutes. So I have to stop here and ask you to go to the next video, and that video will explain how we handle a return of credit. If a customer buys something on credit and returns it, we'll examine how that is handled. So this time, let's go to the next video.